I'm Charlotte McLeod with investingnews.com, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for being here today. Great to talk to you.
Thanks for having me.
Really good to be catching up with you. It's been a while, and we're here at the New Orleans Investment Conference. So you've done a couple of talks here already, and sadly, I missed them both. So we're going to talk about that.
Man.
I know, it's so sad. This is what I get for flying in a day late. So when you're doing your precious metals panel yesterday, I think I was still on the plane. So I wanted to ask you about that, see what are some of the topics that were coming up during that one, because it sounded pretty interesting.
So one of the topics that sometimes frustrates me is people talk about GDP, I think too much. And I've written a ton about why GDP is a terrible measure. It doesn't measure the economy. And so I think it was yesterday, I think it was because I've been doing a lot of travel. I flew in from Europe the day before, so my head's in another time zone. I've been spending a lot of time on planes and not necessarily reading financial news. But the GDP number came in at 4.9%. And everyone was, discussing, is this mystifying, is this baffling, why such a strong growth? The economy doesn't feel very strong, et cetera, et cetera. And I think people lose sight of the fact GDP includes government spending and also includes credit card spending. So if the government borrows and spends, or if people, take out loans on their credit cards or take home equity lines out or whatever, that all adds to GDP. So GDP is kind of production plus destruction. Like, you have the sign wrong. Destruction should be subtracted, not added. But as long as the government is spending and adding, I don't think it's going to continue at this pace, but $1 trillion a month to the debt, well, that's adding $1 trillion to GDP. So of course the GDP number is up. That doesn't mean the economy is good. It means GDP is a terrible measure.
Very interesting. So this is one of the things that came up or maybe didn't come up on this panel. So I guess the question to ask after that is what's the better measure? What would you prefer that we look at?
I'd rather look at something like a national balance sheet. So, GDP is measuring essentially cash flows, but it doesn't say whether the cash flows are productive or unproductive, destructive, borrowing to consume. You load up your credit card to go on a bender to Las Vegas. Okay, that adds a lot of spending. That is true, and undeniably so. It's not fake. You don't need to go to some shadowy website to tell you that it's not real, but it's not productive, it's not constructive, and it's going to leave you with a hell of a hangover for years or decades as you try to slowly struggle to pay that off. If you look at something more like a balance sheet, so presumably everybody's working or has some sort of income, and that's adding to their net worth, and then their spending, which is subtracting from their net worth. Did you go up or down by the end of the month? That's a much better measure of something than how much did you spend without caring whether it was on your credit card or whether it was your salary you were spending. Even looking at balance sheet is problematic because as the interest rate changes, that changes the value of every asset. But at least it would be you're looking in the right area, you're looking in the right direction.
Okay. And so, if you do start looking maybe more in that balance sheet direction or at other measures that are not GDP, what does the health of the U.S. economy then look like to you?
We have an awful lot of borrowing to spend going on. And there's a saying that I've always thought, so I'm not a baby boomer, I'm Gen X. And I don't know the mix of your audience, I'm guessing you're millennial. But I think of this as a baby boomer expression, which is it's not a problem until it's a problem. Right. So all this borrowing, what does 33 trillion mean? Right? So assuming there's about 100,000 people who work in the productive private sector, so people who work for the government, obviously not on net paying off the debt because their salary is coming from the government itself. So let's say 100 million people in the US working in the productive sector. 33 trillion is $330,000 for every working person. So if you have a married couple that are both working, their debt burden for just the federal government level is $660,000. Not counting most of the states are deeply in debt, most of the cities and municipal water districts are in debt. Then there's also corporate debt, business debt, obviously personal credit card, student loan, auto, on and on and on and on with debt. Is there any way that the average working couple could amortize $660,000 of debt? There's no way. So what cannot be paid will not be paid. This is going to be a horrific crisis, but not today. Today everything's fine, but the economy gets more sluggish, the economy gets weak, more and more of what we borrow goes into non-productive purposes. So people look at debt to GDP, and that's a very worrying number. They should be looking at marginal productivity of debt. So marginal productivity of debt, MPOD as I call it, is a measure for each fresh new dollar that is borrowed, how much does that add in GDP? So for every squeeze, how much juice do you get? That number has been declining since at least 1950. People should be worried about that. It's not a crisis right now, it's not a problem now, but this is getting worse. So is the economy healthy? Hell no, it's not healthy. Does that mean people don't have jobs at the moment? No, people have jobs at the moment. We'll see what Powell's interest rate hikes eventually do to that, which is a whole other topic.
That is another topic, and I think we can go down that path. So we did get the latest Fed meeting recently. They left rates unchanged. They are still high. So yeah, let's hear your thoughts on that, because you may have a different idea about what's going to happen than others.
So most people think hike interest rates to deal with inflation. And I say, wait a minute, you're hiking the cost of capital. So lockdown and the whiplash from lockdown destroyed companies all over the economy, from small restaurants to logistics and supply chain and shipping companies. There's obviously demand for the goods, so those either those companies have to be reformed, or those entrepreneurs have to form new companies, or other companies have to somehow raise capital in order to replace the capacity that was lost. We're now hiking the cost of that capital massively. Is that what you want to do just when everybody's trying to replace the capital that was destroyed? Anyways, if you care about consumer prices, you shouldn't want to do that. But there's a whole other problem. And so I published something, an article, it's called Keith Weiner's Macroeconomics Equation. And most of what you see for equations and macro are rubbish. I call it physics envy. So physics has PV equals nRT, the ideal gas law, and the monetarists have MV equals PQ, which sort of looks like that. That doesn't really work. But my macro equation is R is greater than I. It has to be. So R is the return on capital, has to be greater than the cost of capital. You can't borrow money at 10% to open up a hamburger shop that makes 8% return on capital. It's a losing deal. So if you hike the cost of capital, then return on capital has to go up. How does that happen? By liquidation and destruction of all the supply out there, so that supply is reduced sufficiently that what's left can raise their prices enough to get return on capital above cost of capital. So we're hiking the cost of capital right now with a lag. Liquidations, bankruptcies, asset fire sales, all are coming, and layoffs. But there's a lag. And the lag is variable, the lag can be long. I think one of the things that's happened, just talking about that lag, is if you're a CEO and you realize there's a business cycle, or really it's the Fed's credit cycle, but whatever you want to call it, and you realize that, the smart thing to do when you see the downturn is do the layoffs as early as possible into that downturn, preserve your capital. Then when you see the things turning and on the upswing, you hire before everyone else. So you save money as everyone's going down, and then you spend to grow ahead of everyone else and grab market share into the rise. So the Fed has had a number of head fakes since 2009, where everyone thought, recession, interest rates going up, whatever, and companies did the layoffs. And because it wasn't real, it was a head fake, every one of those companies regretted it. And 6 months later, they were calling back all the employees they just laid off and said, please, would you come back, please? And then they're paying them huge bonuses and doubling their salaries and all this stuff. So now, this one is different from 2015, for example. But companies, I think, and there have been some layoffs, but companies, I think, have been reluctant because it's like Pavlov's dog. You ring the bell 17 times, by the 18th time, the dog knows what to do. Only this time is different, and the dog doesn't realize it yet. But all that's coming. And so we stand at that moment.
Right, and so not now, but in the future, and probably, so we have this lag effect that's going on, right? Can we say with any accuracy really, like when that catches up with us, or is this to be determined?
So one thing you can do is you can look at the maturities of all the debt that's out there, right? So the problem comes, so let's take residential mortgages, for example. The US is kind of a unique market I don't think really exists in most other countries. A few, maybe, I'm not sure about Canada. The mortgages are fixed rate mortgages for really long terms, like 30 years. Most people 30-year fixed. So if interest rates go up, it doesn't affect people who are living in the house already. Now if the value of the house goes down, people might walk away if they're underwater in terms of equity. But if they could afford the payment last month, they could afford it this month. But in most countries in the world, they're on variable rate mortgages, which means if the interest rate goes up, the mortgage payment goes up. So imagine you're paying $2,100 a month. Okay, I can afford that. And then the rate on your mortgage resets, and now you owe $3,800 a month.
Yeah, no, I've seen that happen to people that I know. So yeah, I know what you're talking
calamity,
about.
and it may not be optional. It may not be a choice. The person may be forced to default because they simply can't come up with that payment, or it would so, crush their lifestyle that they would be eating ramen noodles and macaroni and cheese 7 days a week in order to make the payment, and so they walk away. Well, the same thing happens to businesses. How many hamburger restaurants out there? How many pizza shops? How many whatevers? Poutine in Quebec province. Where they just barely make a little bit of profit margin, and then if the interest expense goes up, they're dead. And so, in the process of trying to deal with that, they may try to lay off some staff and see if they can, save money. But of course, then revenues go down. Fewer staff usually means less revenues, and so you get that spiral. The last time this really happened was 2008. So that's what we're looking at, but not today, but perhaps soon, perhaps 6 to 12 months out. It's very hard to know the timing, but that's the sort of cycle that occurs.
Right, and is it, if we're comparing kind of back to 2008, is it a similar type of scenario that plays out, or is this worse?
Well, the magnitude is worse. So the last time around we had a crisis of too much debt. So what they did is they fixed it by pumping out more debt. So the magnitude is worse, but I think there's a key difference, which is today, the Fed, if you ask them about the Fed's performance in 2007, they would say that the 2007 Fed was asleep at the switch, asleep at the helm. And so today I think the Fed is hyper proactive, whereas in 2007, they were in the previous mode, which was to try to be a little bit more distant and aloof from markets. So today, I don't know if it's the Fed or other regulators, but as I talk to people who know the space, let's say annuities, for example, if you're an asset manager running an annuity, each asset you buy, you have to reserve a certain amount of capital based on the risk of that asset. So if you're buying short-dated T-bills, very little to no capital is to be reserved. If you're buying 20-year junk bonds, you have to reserve a lot of capital because there's a great risk that will fail. So what's happening right now is the spread between junk bonds and treasuries hasn't really blown out. Like junk bonds have higher interest rates than treasuries, but the spread between the two should have widened massively with this hiking cycle, and it didn't. And so a lot of people are asking why. Why has this not become a problem? The regulators I love the word nudge from Cass Sunstein when he sold Obamacare. The regulators are nudging the market by giving them a green light to buy, like annuities, for example, to buy junk bonds and not reserve capital against them the way they should. And so the annuities are becoming unsound or more unsound as a result of the regulators saying, we encourage you, wink, wink, nudge, nudge, to buy all this toxic waste because it pays 3.5% better than treasury bonds, right? So there's an incentive to do it, and if the regulator gives you the nod, well, why not, right? And if you don't do it, all your competitors are doing it, you're not competitive. So that's very perverse, and so you haven't seen junk bonds blow out the way they did leading up to the last crisis. So it'll take a different flavor, but at the end of the day, it's a crisis of we've borrowed too much, there's too much debt, the debt's not productive, there's too much malinvestment, the malinvestment has to be liquidated somehow, and as the pressure builds, it will find an outlet. And if you want to plug this escape valve and you want to plug backup escape valve, something will happen, somewhere as the pressure grows.
Right. And you started to talk about treasuries, and before we turned the camera on here, you were telling me a little bit about some misconceptions that people might have around what's going on in that situation. So I don't know if you've covered it as much as you'd like to. Is there anything you would add there?
Yeah, so people look at, there's two things they think about the treasury bond market. One, that the Treasury is going to not be able to pay interest because, at this interest rate and all this debt, obviously the interest payment is much higher. To that, my answer is the Treasury, U.S. Treasury will be the absolute last debtor in the world to default. After everyone else has already defaulted, they will be the last one in the end. So of all the problems we have to worry about, U.S. government defaulting is not one of them. Number two, people are saying, well, with all this Treasury bond issuance, look at how fast the debt is growing, there's going to be insufficient demand to meet supply. And this is one of those, for people that are familiar with gel man amnesia, this is the phenomenon that people read on page 1 of the newspaper, some stupid story that absolutely doesn't make any sense. And they laugh at it and say, these are idiots. And then they turn to page 2 and they forget that the paper was idiots on page 1, and they're completely credulous on page 2. So Michael Crichton had a comment about this, and he said, the newspaper is full of stories where they say wet street causes rain. Like they've got it backwards at a mechanical level. Before you even get to their theory, they don't even understand what caused it, what happened first, and what the effect was. And so, every dollar is just a slice of the government's debt. Every dollar recycles into the Treasury bond market. There's no such thing as too much supply and not enough demand. That's mechanically impossible. There's no such thing as the street getting wet somehow and then causing rain as a consequence of that. You've got it backwards. There's always demand for Treasury bonds because to hold the dollar is either to buy Treasury bonds directly or give it to a bank who's going to buy Treasury bonds with your dollars. So no matter how big it gets, there's always enough dollars to buy the Treasury bonds. That's not the problem. There's a lot of problems with the system, but that's not one of them.
Okay. I think that hopefully will help people understand a little bit better what's going on there. I hope we can maybe move over to gold and kind of explain what all of this means for gold. So we have gold is still historically high. People wonder why the price isn't higher. What are your feelings on the gold price right now? Does the level make sense to you?
Yeah, it's, at a very simple level, the price is, by definition, it's a balance of sellers and buyers, right? So if more people suddenly sell with urgency, then they keep pushing the bid down, and if more buyers are buying with urgency, then push the bid up. But the fact that somebody famous, let's say a central bank bought, doesn't really tell you which of those two is happening. Is it that there's, I call it the famous buyer fallacy.
Oh yeah, we talked about this, yeah.
Right, so the central bank of whatever country bought. Okay, did they bid it up? Or was there, 100,000 anonymous, not famous sellers, and they happen to be the buyer that put in the bid, to get that gold. But I think right now you have a combination of two enormous forces, and it's been this way for a couple of years, which is there's a lot of people that are forced sellers. They don't necessarily want to sell. Like you talk to a lot of the bullion dealers here, and people who bought gold from them, maybe earlier this year or last year or the year before are now coming back to sell it. And some of them, maybe they're selling because they think price went up and they got their gain and that's it. I don't think most people buy gold, gold coin thinking they're going to sell it if the price goes up $100. I think a lot of them are under stress financially, and gold is the liquid, which is the reason why they bought it. It's a liquid asset that you can sell when you need to sell something. So I think there's forced selling, and at the same time, there are people that are buying because, hello, the madness of central banks. Do you really want to be a creditor to the Fed and own dollars, or creditor to the Treasury and own Treasury bonds? It's absolutely nuts. And it's nuts worldwide. The US is not unique in any way in having gone mad. All the countries have. So in the US right now, the gold trade is, I don't necessarily call it moribund, but slower. But not so in the Middle East, not so in India, not so in Turkey, not so in Asia. They're buying because they see what the dollar is doing, and they're on the receiving end of that. It's not doing any good for them. They don't trust their local currencies. What do? They buy gold. So gold is being bought massively in certain parts of the world. Gold is being liquidated, in many cases involuntarily, and then you see a gold price that doesn't seem to want to get out of a range of 1900 something to 2000 something. But I think we're not in the bear market of 2012 to 2018. We're in a bull market, maybe with volatility and uncertainty and a lot of sideways motion. But I think we're in a buy the dips market, which is not what we were in 2012 to 2018. That was a sell the blips market.
Okay, and on the note of gold, I know one of the other topics you're speaking on here is what's going on with the BRICS and their possible currency. So I wanted to at least bring it up, see your thoughts there, any points you would mention.
So, and this is basically what I said in my talk this morning. I met with somebody in the gold trade in the Middle East who was of Indian origin, not a fan necessarily of America and our foreign, let alone our foreign policy, but even our monetary policy. Very nationalistic, patriotic to India, very loyal to Modi, Prime Minister Modi. But when the topic of the BRICS, so-called BRICS currency came up, he laughed. He said, it's a joke. He said, have you seen the chart of the rupee? Have you seen the chart of the yuan? Have you seen the chart of the ruble? Have you seen the chart of the Brazilian real? He said, they're all falling. And this one is 67%, and this one is whatever. He said, so you're going to combine 4 small falling currencies into one big falling currency. He said, it's a joke. He was just laughing. And what I think they're going to do is not try to make some sort of new currency, which I don't think they can agree on that anyway. Gold is the one thing that doesn't require agreement. If I put gold on the table, anybody is happy to deliver oil, wheat, electronics, you name it. No questions, no further discussion is necessary, and nobody has to trust anybody because gold is gold. So I think, as those countries try to do bilateral trade, so Russia is selling oil to India, and at first it was, oh yeah, all for one, one for all, we'll do trade in their own currencies. So India was paying Russia in rupees, and probably stickering up their sleeve, suckers. Russia announced, actually said to the world, that we're not going to accept rupees anymore because we've stacked up a pile of useless, was their word, rupees. So they were thwapping their trade partner, verbally with that. But, India has capital controls. Rupees are not useful outside of India. Nobody wants them. China has capital controls. Yuan are not useful outside of China. Russia has capital controls. Of the 4, Brazil is the only one that doesn't. It's an open capital market. So none of them want their own currencies. What I think they're going to do is they're going to pay in gold. To settle the differences. So country A sends something to country B sends something to country A, but this was slightly more valuable, so the difference is settled in gold. And I think at first, obviously, they're going to put bricks of gold on an airplane and fly it over, because that's what you're going to do, right? That's how the gold market works. It's a physical delivery kind of system. But I think fairly quickly, maybe that takes a few years, maybe that's faster, everyone realizes, man, what a waste. What if we all had a jurisdiction that we could agree on, that we could all have gold in the same jurisdiction, even the same vault within that jurisdiction, and now if I need to pay you 1,000 ounces of gold, I just send an order to transfer within the vault to you. So I'm Russia, you're India, or whatever. So I think that's what happens next. And then the question is, what's the jurisdiction? I think the answer to that is Dubai.
Okay.
Dubai is neutral. It's not Switzerland. I mean, Switzerland took the side of the United States and sanctions against Russia. So Russia's not going to go for Switzerland, and Switzerland wouldn't accept Russian gold at this point. I think it's Dubai. I think will be that jurisdiction. I think the gold will come there. It's already coming there anyway for other reasons. And I think you begin to see organically, feature by feature, evolving, not because some fancy economist, including myself, has a theory that says this is how it's supposed to work, but just because everyone has a need to accomplish a certain goal in the transactions they're trying to do, and that's going to be accomplished by building a gold standard from the ground up. So they're going to have the gold there, they're going to be trading warehouse receipts rather than actual bricks flying on airplanes. From there, finance is going to come up. From there, earning a return is going to come up. That's what monetary metals do. We pay yield on gold. So we intend to be there. And within the limits of the law, obviously, we can't deal with Russia as a counterparty, but to facilitate that for finance and pay a yield on it and so on. And I think that's going to evolve, because no paper currency can replace the dollar, not even remotely close. A dollhouse can't replace a skyscraper, not even remotely close. Gold is the one thing that can, and nobody really wants it to at the official sector level, but they're going to end up using gold because nothing else works. It's the old Winston Churchill quote during World War II. He said, "God bless America." And there's a very backhanded compliment, because he said, "God bless America because after they've tried everything else, they'll do the right thing." God bless the world, because after they've tried everything else, they'll go to gold.
Okay, I'm glad I asked because, yeah, I've heard a lot of different BRICS gold ideas, and that's one that I haven't heard before. So just one follow-up, and that is, what effect does this possibly have then on the gold price, if any?
So as gold becomes more and more of a monetary system asset, people are going to want to own it. And so extrapolate from there. I wouldn't care to make a price prediction on it. But as you go to a gold standard, price of gold being money, the dollar being some failing, dying currency that's fading away, the price of money in terms of failing paper becomes less and less relevant. So it's more, are you going to get rich buying gold? I mean, you never did. Rich people own gold, but they didn't get rich because they bought gold. They bought the gold to preserve the rich that they already had. So, if the paper currency is failing, so imagine you're on an elevator that's about to drop from the 27th floor into the basement and crash, and you step off the elevator onto the 26th floor. Are you skyrocketing while you're standing on the floor? No, you're not. But you avoided crashing into the basement and perhaps dying in the accident. That's what gold always did. People are going to get richer by holding gold, perhaps, but they're going to get poorer by holding dollars, that's for sure. So that's really why I think people should be owning gold. If you want to speculate on something that's going to skyrocket, that's not really what gold does anyway.
Yeah, I think that's a really good distinction, and I think this is a nice note to wrap it up on. I think, yeah, this is really good. Thanks for going through all your different thoughts and some of the things you said at the conference here. It was really good.
All right, cool. Thanks for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Keith Weiner with Monetary Metals. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.